The Construction Market Guide is designed to provide contractors and construction executives with timely data on the economic environment, materials prices, and the labor market so you can make informed decisions that increase profitability. The latest inflation numbers are out, and today we're at a 3.3% annualized rate of inflation. Federal Reserve Chair Jerome Powell, in a press conference today, said we've made modest further progress toward their 2% inflation target. I wanted to look at where inflation is coming from, and as you can see, this breaks down the components that they measure when we look at inflation. Auto insurance is the biggest, kind of a standout here, increasing on a 12-month basis by over 20%. So don't be surprised when you get your next auto insurance renewal if you see a big jump. And that's just been the trend across the board. Rent continues stubbornly to increase, as does housing. Again, a lot of that driven by the high interest rates we're seeing. And on the flip side, we're actually seeing disinflation in used vehicle prices, again, as supply chains normalize post-pandemic, in rental cars, toys, airfare, and a host of other fixed products. We see materials prices, again, following a similar trend depending on which sector we look at, but oil up about 15% over the last 12 months, but other materials prices for the construction industry moderating quite a bit. Asphalt and paving mix is up 4%, iron and steel down about 2%, and lumber down about 5%. When we look at unemployment and wages, this is a 50-year chart. Really want to show the long-term averages of what we're normally seeing as compared to what we're seeing today. So the unemployment rate over 50 years has averaged 6.2%, and today it's low at 4%, and it's remained pretty low. Wage growth, again, the increase in wages that people are seeing across the economy historically has averaged 3.9%. It had run up in March of 2022 to as high as 7%, and that's come down. That's moderated now to where it's at about 4.2% as the average wage increase that workers are seeing across the economy. The new unemployment claims, this is a one-year chart. We can see they're starting to trend back up, again, as there's signs the economy is starting to slow down. And construction unemployment, though, remains low as the employment situation in construction is strong. The unemployment rate's below the national average for all industries. Now it's at 3.9% relative to 4% across the board. Again, some signs of slowing in the new housing starts. We can see that they've come down a bit from where they had been, and the Architectural Billing Index continues to reflect weakness, and especially in the Northeast. It's in contraction territory where, again, design of new construction projects is showing, again, weakness and a bit of a contraction. Again, all this is driven by the Fed's deliberate attempts to slow the economy and bring down inflation by raising interest rates pretty dramatically. And you can see what has happened over the last year and how much of a change it's been. Again, we've gone from a 10-year Treasury rate of 3.75 up to almost 4.5%, where we stand today. The stock market has been an interesting mixed bag with big differences in performance depending on sectors of the economy. In particular, you hear a lot of talk about artificial intelligence, and NVIDIA, which is a chip maker who focuses on AI chips and development in that space, has had an incredible return year to date of 144%. Of course, that changes every day, but they've crossed a $3 trillion total company market value, so the fastest of any company in history here. And if you compare that to the rest of the economy, and in particular, if we measure the S&P 500, so a weighting of the 500 largest publicly traded companies, weighted by their size, we see the S&P up year to date about 13.4%. So again, a huge difference there. And if we instead of weighting companies by their size, we weighted them equally in the S&P 500, again, de-emphasizing the largest companies, we would see that the rate of return for an equal weight S&P 500 index is only about 4.56. So 4.5% versus 13% for the S&P, quite a difference there, reflecting that some of the largest, especially companies that are focused on artificial intelligence, have really made up a huge component of the return so far this year. So again, it's a good time to take a look at your personal financial goals, review your investment portfolio, and make sure that your investments are allocated properly for what you're trying to accomplish. If we can help in that process, please reach out to us. We're happy to chat. Thanks.